Phil O'Neill, M1 Capital. We've got Mike Beck, who we've already heard from today, and Matt Geiger of MJG Capital, who spoke yesterday. And Michael from Kitco has been kind enough to offer to moderate the panel. The concept of the panel is a lot of us forget what a bull market in the mining sector is like. I'm starting to forget myself. So these three all have intimate knowledge of what that's like, and we're going to ask some questions around that. You guys can sit here in the front row.
Excellent. Glad to hear. Thank you very much, everybody. You have chosen well. This is the best panel to finish today's event. We are going to be looking at what is it like to be back in a bull market? How can we look forward to this? Maybe we'll just go through the panel one more time. Again, if I could just introduce, it is Mike Beck. He is with Region Advisors. Could you stick up your hand, Mike? Yep. And then beside him is going to be Matt Geiger. He's with MJG. And then lastly at the end, that's Philip O'Neill, president of MP1 Capital. We've had a tough year. This was supposed to be a good year for copper, and we started at $2.90. We were up that was about 2 months ago, and we've dropped 20 cents, and that's been what we've had with the tariff tips. We've also had with what has been happening between the two largest economies. We've also been looking towards gold, and we would have expected something to come out with gold because Lord knows it is volatile there right now with all that is happening within the news. But we have seemed to have been range bound. We started at 1280. We continue to be at 1280 right now with precious metals. We want to go back. We have these esteemed panelists up to us just to remind us, what is it like to be in a bull market? What are the signs? Maybe if we can kick it off with yourself, Mike, if you can help us out there. What has been your past experiences of what it is like being in a bull market? Remind us.
Well, I'm not sure I can actually remember. It's been so long. You know, ever since the downturn in the sector in 2012, it's been tough sledding, increasingly so. What does this feel like compared to a bull market? Well, and there are some people in the room like Frank Holmes that, like me, have been around long enough to remember. In a bull market, if you didn't make $1 million by lunchtime, it meant somebody didn't like you that day. Just everything indiscriminately went up, and there was unlimited or virtually unlimited capital available. If you had a half-baked idea, you could raise sort of in a couple of days, soft circle $2, $3, $4, $5 million and get going. And that doesn't exist anymore. I think part of the problem is that there's been a structural shift in capital markets, and the passives, which really didn't exist in a meaningful way 10 years ago, have come to dominate. And they don't fill out subscription agreements. They don't meet with management teams because it's an algorithm and it rebalances in accordance with an index. And so that has shut out a lot of what used to be a principal source of capital. A lot of the funds that were go-to funds in New York and Toronto and London either don't exist anymore, or if they exist because of the new compliance regs, they can't invest in anything that has a market cap of less than $1 billion and trades less than, $50 million a day. And that's not our industry. Our industry is a smaller cap stocks, the exploration team or management team that has an idea. And so it's fundamentally different, I'm afraid. I think this time, I hope I'm wrong, but it's tough.
Well, as a professional investor, I've really only seen 2 years of a bull market, so maybe not the most experienced in terms of bull markets on this panel. We launched in 2012, right in the depths of a bear market, well, going into the depths, I should say. And it persisted from, I would say, Q1 2011 through January of 2016. I'm then of the opinion, and a few of us were arguing about this last night, but that we were in a bull market between January of 16 to January of 2018. I'd say the best example of kind of the euphoria that you'd see in bull markets occurred between the spring of 2016 and August of 2016, where you saw stocks running literally 3, 4, 500% on not particularly exciting news in some cases. It was more of just a relief rally of epic proportions. And I don't know, in these bull markets, it's easy to get swept into the euphoria. It's easy to loosen your standards, to make investments that you wouldn't make when times are tougher. So I think it's incredibly important to keep a cool, steady head, a calm demeanor, not get swept into the euphoria that the sector is feeling. Yeah, we can touch on when we expect to see a bull market next.
Yeah, I meaningfully got involved in this industry in possibly the biggest bull market there was in uranium. So that's where I started taking punts in 2003, and I've never seen anything like it, and I'm not sure if we'll ever see anything like that again. 2012 to me was just a cyclical kind of turn. It wasn't it wasn't a real bull market like we had in 2003, 2007, uranium when it went from $10 to 146, and I did 100 private placements in uranium juniors, and making 25 times your money. I came to realize in 2009 that's not normal, and that doesn't go on forever, and boy do we miss those days. So yeah, the industry's changed quite a bit as well. It used to be, there's a shift in the age of people. I don't think millennials are newsletter readers. Our entire industry, especially in Canada, is predicated on the deal. Whose deal is it? Who's getting in? Who are the influencers? This and that. It's changed a lot. Nobody goes to investment conferences anymore. You don't have this. The influence of newsletter writers is not what it once was. I don't know what causes a millennial to buy a stock, but they don't attend junior mining conferences, at least today. That may change. That may be the state of the market, but it's we're not in a bull market, and I yearn for those days again.
Thank you very much. I'd like to talk next about what you would see as being the factors that would generally lead to a turnaround. Rob McEwen had his own slide where he was talking about a late equity bull market, and then that would be doing well for gold. But I'd like to hear from the panelists down what they would look at, and we'll get into sector picks, but what generally they see as the coming bull market, because the bull market is coming. I'll start with you, Mike.
I think that you need a catalyst, and I think the only meaningful catalyst is you get a major uptick in metal prices, and I suspect it'll be selective. We've seen that in the last sort of 6 or 7 years selectively. So for example, there was sort of the run of the lithium stocks, where you went from basically 2 lithium stocks, SQM and Albemarle, to 200, and that was sort of a selective bull market. And then you had the same sort of dynamic with cobalt, and that's kind of over. But I think until you have a major significant run in one or more metal prices, and maybe the EV thematic delivers that, you're not going to attract investor interest back into the sector. And I mean, what does a bull market look like? I guess the best answer to the first question is, thinking about it, is, well, look at the cannabis space, right? That's a bull market. We've gone from no cannabis listed companies probably 3 years ago to, somebody sent me a sheet last week, there are now 387 on its way to 500, and eventually that sector will roll. But that's a bull market where you go from, literally no companies, no listed cannabis companies 3 years ago to nearly 400 on its way to 500 or 600, and there is not a day that goes by where you don't read of not one but sort of 5 to 10 new financings and maybe 3 new companies listing a week. And that did exist from time to time in the mining sector, and hopefully it will come back. But I think the only way it does come back is if you get a major, like pick a metal, nickel and copper really start to move in a meaningful way. Shortages develop, people panic, and then it all of a sudden investors that aren't in the sector now get interested and say, wow, there are disproportionate returns that can be made. And that brings the investor and the capital back to the sector.
So I'll step back even further and I'll say what you need for a powerful, sustained bull market is a long and painful bear market. Authors of bull markets are bear markets and vice versa. I think you need to see the marginal operations turned offline, and we've seen that across many different industries, supply disruptions across the board over these past 4 or 5 years. You need development projects that are moving along the development curve to slow or even stop advancing, and you need there to be a lack of exploration and new discoveries. And bear markets provide all of that, and provide a springboard for the next bull. Additionally, I think some of the benefits of bear markets is it helps rationalize the industry, especially if you're looking at the juniors. You'll see a lot of the management teams that probably don't deserve to be in the space, peter off to cannabis or crypto deals or what have you, and only the true players remain. So I think those, bear markets do sow seeds for bull markets, and it's a healthy yin-yang.
The markets have changed quite a bit as well. To go to a bull market, I mean, it used to be 15 years ago in Canada, Australia, London, South Africa, juniors would offer intellectual capital, punt money, speculative money for exploration. And now you're competing against sovereign wealth funds, China. Junior mining company can't build a highway, can't build a dam, can't provide military equipment. So the game has changed quite a bit. A lot of the nice, big, large projects are not even being looked at by the traditional junior mining company again. And so I do worry. I'm not sure if we'll ever see what we had previously, just because the game has changed a little bit. When the millennials understood cannabis, or continue to understand cannabis, nobody I talk to is that interested in mining. But I guess once money starts coming in and people have opportunities to make money, that trumps nearly anything, and nobody's going to pass up an opportunity to make money if it gets rolling again. But it'll need a catalyst. What that catalyst is, I don't know.
Let's assume that the pieces have fallen into place for your thesis. We're looking towards electric vehicles. We see real demand starting to come on play. We see that China, the clouds have lifted around China and tariffs, and then the build-out is happening with great speed. Mike, starting, you have a thesis. Matt, you have a thesis. Philip, you have a thesis. What are the sectors that are going to work, and where do you position yourself as that bull market, as the recovery happens?
We focused really the last couple of years on, rightly or wrongly, on the EV thematic, and particularly when you reach these crossover points where it's cheaper to purchase and operate an electric vehicle than an ICE, then we think there'll be a rapid and mass adoption of the technology, and shortages will emerge. And the most likely shortages in the supply chain will be some of the key raw materials that go into the batteries. And as I talked about earlier today, our focus is nickel, copper, lithium, cobalt, and I think if you believe that thesis, then this is a good time to lay on exposure in that suite of metals, and then sit back and wait for this scenario to play out. And I believe that we'll start to see that in a meaningful way by 2021, but markets tend to move usually in advance of real development, so this is probably not a bad time to lay on exposure in that suite of metals if you believe in that thematic. And for me, that's an easier sort of play to get my mind around in the metal space than trying to figure out what gold's going to do, because there's no doubt EVs are coming, and then the only question is what will be the rate of adoption. And if it's at consensus, then there's no doubt there will be shortages just because of the lag time for bringing new mines on stream. And so to us, that's sort of the easy play in this space.
Well, I think it's important to have opinions on which metals are going to perform best and have a sense of the supply-demand dynamics. But by the same token, and as a couple of the speakers have spoken about, you want your investments to make sense at spot metal prices, if not lower. And if things improve and move in the right direction, then the rest is just gravy for you as an investor. So we're not big fans of optionality plays in most cases. In terms of the metals that kind of I'm most optimistic about over the next few years, I agree wholeheartedly with Mike about the nickel thesis. I think that's pretty brain dead as EV adoption continues, and as the chemistries of these cathodes continue to transition to more and more nickel-rich chemistry. Elon Musk, as we know, is on record of saying that the lithium-ion battery should really be named the nickel-ion battery, and I think we can take it from him that that's the direction the industry is going. And then we've also seen, up until a couple years ago, close to a 10-year drought of any nickel expenditures in exploration, project development, what have you. So I think the next few years are very bright for that metal. I'm also a big uranium guy. Even though we don't realize it in the Western world, I think most of the world is starting to grasp that nuclear is the only form of baseload power generation that can go 24/7, 365 without any carbon emissions. And again, I don't think the United States or Germany or even Japan really have to come to this conclusion as long as the emerging world continues their reactor build-outs. And again, in China, this isn't out of the kindness of the government's heart that they're doing this, or a love of the environment. It's a political issue. They know that as their citizens in Beijing continue to choke on smog, it takes years and years off their life expectancy. They know that could be the environment could be one of the main threats to the Communist Party remaining in power in China. And so I think that's why they're making nuclear such a large part of their energy suite. And then finally, I would say silver is a metal I'm excited about. I did a presentation last time here that was a bit controversial. I talked about how gold was my least favorite metal by a long shot because its supply-demand dynamics are driven either by vanity or by fear. And for whatever reason, I have a personal bias towards the metals that help us live our 21st century lifestyle. And with silver, you kind of get the best of both worlds, because you got that 60% industrial application, a lot of cool cutting edge technologies, photovoltaic solar cells, ethylene oxide. As electric, there's more and more silver being used in electric vehicles as well. So those are kind of the three exciting ones. And on the silver front, of course, if you see gold go goofy, over these next few years, and we see $2,000 golds and all the prophecies come true, you're going to do at least as well with silver. So I think you cover both bases there.
I'm not a fund manager. We manage our family's money. It's our personal money. I've got views on. I like nickel. I like different. But I'm old school. It's all about the deal. Whose deal? What price? Is there a 5-year warrant? Is it a full warrant? Am I getting in with the other influencers at the right time? It's just very deal specific. I do think the general metal complex is going higher. Even if we're not in a bull market, you can easily make 50 to 100% if you choose the right deals. If you're in a bull market, you're going to make 10 times your money, but you just got to be very, very, the things I'm looking at as opposed to metals is making sure that I'm not taking positions that are bigger than the liquidity of the stock. I don't want to affect the share price if I move off a position. I typically buy my private placement. I rarely buy on the market itself, but when it comes time to selling, you go back to making mistakes you tell yourself not to make, where you've taken a position bigger than the company's volume allows you to get off of, and so I'm pretty. I like gold. I think only because it's been pretty steady here for the last few years. I do like nickel sulfide projects. They're very hard to find. At least I can't find a good company that's got a nice nickel sulfide, because I think nickel is going to be one of the big winners in the battery space. I live in Calgary, still like oil and gas quite a bit because it's real business. It's even in a foreign jurisdiction, you're still 6 months to cash flow. In North America, you're nearly immediately to cash flow. So I don't have much of a take or thesis on where metals are going. I think it's important to know all the players in the industry and try to get in on deals cheap and early when everybody else is writing, when all the right people are writing the checks.
Thank you. I'd like to open it up to the audience. Any questions for our three panelists? Sorry if you didn't hear that. The question was about platinum and palladium, correct?
Well,
okay.
I'm personally bearish on both of those metals. I think the demand outlook going forward is very questionable and up in the air, and a lot will depend on EV adoption rates. So there's a bit of a battle, I would say, between nickel, lithium, and cobalt versus the PGMs and those metals that are used for catalytic converters. I will say, to the credit of PGM bulls, there's been incredible supply disruption for close to 8 years now. South Africa, very little movement on any projects in North America as well. So that is one kind of plank to the bull case. But to me, it's just a massive question mark where ICE vehicles will be even 7 years from now. And that to me doesn't give me a particular amount of confidence invested in those metals. But again, as was mentioned, it is about the management teams, right? So if it's the right project with the right person working on PGM, then yes, of course, I'll take a look at that. But as a whole, that's not in my favorite suite of metals by any means.
Any of the other panelists on platinum versus gold? I think I saw you had a question, Frank, and I saw Geiger. You have a question as well, too.
The chemistries will be the same. In fact, interestingly, for lithium-ion chemistries, which are the dominant and likely to be the dominant even chemistry a decade from now, the transition from liquid electrolytes to solid state implies actually a greater consumption of nickel and lithium, because you're then able to actually achieve higher energy densities without having the corresponding thermal instability problem. And so you can pack more nickel and lithium into an equivalent cubic centimeter of battery chemistry in a solid state. So the transition to solid states, which will occur gradually, I think, over the next decade, because it's a superior technology, will allow actually a greater consumption of those metals, at least per cubic centimeter.
I keep an eye on Linus. There are a couple Australian names that have seen, tens of millions of dollars of project expenditures that are trading at pretty extreme discounts. But again, at the moment, almost all those projects are what I would describe as optionality plays, and they need the NdPr price to go up close to 100% before they really start to make sense. But in this, trade war environment, I know there's very divergent opinions in this room of how things will turn out, but that's a very strong point of leverage that China does have over the United States. And if things continue to heat up, I think investors will start taking a look at rare earth names. So there could be some speculative money to be made there. But again, aside from Linus, at the current NdPr price, like none of these projects are going to be built or really advanced too quickly at all.
I agree that the rare earths will be positively impacted by the adoption of EVs, and increased quantities will be required. And we did look at trying to layer on some exposure, but it's hard, as you know, because there really aren't, with the exception of Linus, which is probably going private with the Wesfarmers transaction. There's really not much to buy. Molycor or the Mountain Pass project is private, so you can't get in that. Those are the two big ones outside of China. And the rest of them are sort of scrappy optionality plays. Maybe the most interesting and advanced is a small cap company called Mekongo, which is listed, I think, on London, has a market cap of 7 or 8 million pounds. It's reasonably advanced in terms of feasibility study. It's in Malawi, but you really can't get much exposure. So I think it's an interesting suite of metals. Demand will go up, but how when China controls sort of 80% of the supply, and most of that's in private hands, I don't know how you get, and that's your question, right? How do you, and I don't have an answer, because I think the short answer is you can't.
I'll start. My two are Pan Orient Energy. Jeff Chisholm just brought some production online in Thailand, and he's going to drill possibly the biggest onshore well in 2019 in Indonesia with Repsol as a 51% partner. That Angun 1X well could be huge. Repsol just found 2 TCF about 10 kilometers away. So I think that'll be very exciting if you're into international oil and gas. And like Marin mentioned yesterday, I'm a huge fan of Liberty Gold. I think their Black Pine project in Idaho is going to be 3 to 5 million ounces of oxide, and any major is going to need to own that.
I don't feel comfortable giving recommendations per se, but I can say what we've been buying. And I also don't feel comfortable talking about any company that we've participated in a private placement with, because I think it's not right to have a full warrant and then be recommending that people pile into the common shares afterwards. So the two companies that we've been recently buying on the open market, they've both been holdings of the funds for at least 2 years at this. Well, one of them was for 2 years. EMX is the first one that I would highlight. That's a company that 75% of their market cap is covered by cash. So they have quite limited downside. Additionally, they're just extremely cheap. So if you look at a company like Midland, which is incredibly well managed, a great prospect generation story up in Quebec, if you look at the enterprise value of that company relative to the expected partner expenditures in 2019, there's about a 15x ratio. So their enterprise value is 15 times larger than the amount that their partners are expected to spend. So EMX has a $40 million Canadian enterprise value across their projects in Turkey, Scandinavia, and the United States primarily. They're going to see $20 million this year Canadian in partner expenditures. So a 2x multiple there. So EMX is probably my top open market pick at the moment. And then we've also been buyers of Cisco Metals as well. That's more of a people play right there. Bob Wares, over the past 6 months or so, has plowed 4 to 5 million Canadian of his personal money straight into a Cisco Metals. That's the money he just made from Arizona mining. That's a geologist that I respect an incredible amount, and I think it's a great opportunity to be able to invest alongside him at roughly the same share price.
I want to thank our panelists. Please
you.
give me a hand in thanking them.
Thank you.
That was Michael Beck. He's Managing Director, Region Advisors. Matt Geiger in the middle with MJG Capital, and then Philip O'Neill with MP1 Capital. My name is Michael McCray. I'm with Kitco News. Please also let's thank our hosts, Palisade, that has made this a wonderful conference available to us. Thank you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?